screen now. I'm assuming that you all have the template that we are going to be working with today. If you don't have it, I think Samson should be able to share it, or the CFA Society should be able to share with you because I shared it earlier. But again, if you have it and you feel like you learn better by watching how it is done, you can always just come back to this recording session and follow through the session while you then practice it on your own. So I'm going to start with sharing my screen. Today we are going to talk about modeling, like I said, but before we go into modeling proper, I'm going to share a quick one on scenario analysis. My assumption is that we already had some session on financial analysis, industrial analysis, and I believe that some of the conversations that we would have today would no longer be unfamiliar to you because you have an understanding of what you need to do as a base before you then start working on the financial modeling itself. That being said, I need to be sure if you can see my screen because right now I can't really see anything. So I need someone to confirm they can see my screen.
Yes, we can.
Okay, fantastic. So let me see if I can increase if the visualization is is visible enough. But anyway, so before we start, or before we delve into financial modeling itself, I just want to do a quick one on scenario analysis. And what this means is that I understand, during your industrial analysis and when you were talking about financial analysis, when the teaching guys ratio and all of that, I want to believe that they must have told you that the future is difficult to predict. And the way you think about modeling is that you are not necessarily giving an assurance to an investor. You're only giving a reasonable, a reasonable estimate of what you think the future would be based on the information that is available today. And as a result of that, it is most of the time important for you to give do a scenario analysis just to play out the possible things that could happen if your base assumption changes. So most of the time, we usually do what they call a base analysis, which is like if everything is held constant, like the economists, students will say that the ceteris paribus, you hold everything constant. If all of your assumption does not change, this is what's going to happen. But in some situation, the economy and all of these things that you are estimating, life might turn out to be even better than you had estimated or you had expected. And in time of prosperity, your base would or your base or your assumption about the company will most likely be better, right? And as a result of that, it is usually like reasonable for you to do a best case scenario, like in case in a situation where things are very good or things you have a situation where growing and consumers are richer, people are employed, and all of that plays out into demand of your sorted company products, and of course that plays out into revenue, profit and cash flow. So you do a best case scenario, and of course you do a worst case scenario, because like what happened in 2019, 2020. In 2019, most analysts wouldn't have expected COVID to happen. And of course, like COVID was like something that when it happened, it affected a lot of businesses. In this situation, you tend to like stress your model to say, this is what I'm expecting, but what happens if the worst happen? What happens to what happens to the business, financials, if we have a worst case situation? And that is why most of the time we do a worst case scenario. So it is usually a base case that you tend to work with when you start your modeling. Of course, you're going to keep it as a base case, but when you start, when you want to look at the scenario, what could happen, what could not happen, that's when you tend to do best and worst case scenario. There's a lot of ways you can do your scenario analysis, but I think I've presented about 3 or 4 using some formula. I'm going to share this with you. So there's no point in trying to probably you want to if you have any question, you can easily go through this formula. It's pretty much straightforward. So there's some Excel function that you might use. there are more than this actually, but I think I've kept it to like four. And I think we're going to be using one of them today, which is the XLOOKUP. I think some Microsoft Excel version does not have XLOOKUP, and that is why, I gave some different options that in case you have, some Excel version, maybe you're doing, for example, I'm using Microsoft 365. You may not be using that, and you may not have some certain function. But if you don't, of course, like there's usually the E formula, there's the choose formula, there's match and index and different kind of formula. But once you get the idea of what this Excel function does, then most of the time you can easily you use your own preferred formula to do whatever it is you want to do. So I'm going to use a sales growth to give you a quick example of what I'm talking about. So let's say, for example, you're assuming that your sales, in a base case scenario, like you look at this row 9, the base scenario is that, if everything remains constant, you are expecting that probably year one is going to be, we are going to have a revenue growth of 6%, next year 5.5, 5%, 4.5, and like that. But in a best case scenario, as you can see, when you're talking about sales, right? If we are talking about a base case, you're expecting like a certain number of growth. But if we are going to be having a best case scenario, that is sales is going to be better. Of course, like that means that growth is going to be more than what you are in the year where you're expecting 6%. The best case scenario here is that, if life gets better and probably we get to see some upside potential, in the economy, and we are seeing economic prosperity. We can assume that the best case scenario for revenue in this case, you are going to see a higher growth. But in a worst case scenario, that means that if your base is 6%, that means your growth is most likely going to be lower. And unemployment is high, growth is down, the economy is not growing, so that plays out into demand. And in that kind of situation, we have a worst case scenario, and you can see that the growth rate is lower. Now, just to give you a quick differentiation when you're thinking about scenario analysis when it comes to revenue and cost. For revenue now, we are assuming that uh, in the worst case scenario, growth is lower, and in the best case scenario, growth is higher. But when you are dealing with or when you are dealing with cost generally, either cost of goods sold or either operational costs, either name it. When talking about cost, in a base case scenario, right? You have a certain number. Let's say we are saying that 70% of your company's cost of sales I'm sorry, 70% of your sales is going to be your cost of sales. In a best case scenario, what will likely happen is that your cost to your sales is going to be lower. That is better when you're thinking about cost. But when you're thinking about a worst case scenario, of course, like in the best case scenario, if your base is 100, right? You have 100 as revenue. I'm trying to put in. Hold on, my keyboard is not working. I think this is in read-only mode. Okay, let me use it. Let me use it just to do a quick example. So if your revenue is 100, right? And you are saying that your cost of sales is 70% of it, what happens to your gross margin, your gross profit? That means that 70% of 100 is your cost. And when you deduct 100 from 70, what you have is 30, right? So that is your gross profit. But in a best case scenario, if you're saying your cost of goods sold is just 68% of your revenue. So 68% of 100 is 68. So when you say 100 minus 68, so it's no longer going to be 30, it's going to be 32. That means your gross profit has increased. But in the case where your worst case scenario happen and you have 72% of your revenue is your cost. That means you're spending a lot of money. You are spending more to actually achieve that revenue, and your gross profit will be lower. And that is just an example. So when you do all of this assumption of base case, you can, again, this is just for sales and cost of goods sold. Some analysts are very granular, they're very rigorous. They'll do all the line items, but I don't think that is necessary. You just need to focus on, what are the key drivers of this, company, or what is more important as far as like, the company financial statement. What are the line items that are very important that if it changes, it's going to significantly affect the value of the stock, right? It's going to really affect how much you are pricing that company's stock. Those are the kind of line item you might want to do a scenario analysis for. But here you have just focused on just sales and cost of sales, right? And once we've done all of these scenarios, you've modeled it out, then the next thing is that then you're going to, you know, have a single line where you're going to bring in the formula that is going to drive your income statement. So we are saying that in this scenario, for example, we have used the choose formula. And as you can see, what the choose formula is saying is that if my scenario selection is one, right? One represents my base. This is not a very dynamic example. And that is why I'm going to be using the best. Sorry, I'm going to use the X lookup now for our own scenario when we start modeling. So when we are saying that the base is one, and the best case is going to be two, and the worst case is going to be three. So right now, because the scenario selection is at one, right? So I am saying that. Okay. I'm saying that my sales growth, if my scenario selection is one, it should be 6%, right? If I change this, for example, to two, right, it's going to change from base case to best case. And as you can see, the actual assumption that is driving the model is here. This is it. This is what I've highlighted here. That's what is driving this income statement that you are seeing down here. So it has moved from 6%. Your sales have moved from 6% to 10%, which is best case. And likewise, your cost of sales has moved from 70% to 68%, right? So that is just to show you what is happening. Then if I change it to three also, it moves from best case to worst case, and the numbers are changing. Now you have to be very careful when you're having scenario analysis in your model, because if you don't drive it well, by the time you start changing everything here and there, and it's not driving it to your model, then that means something is wrong. So that's like just one of the example. You also have when you're using the offset formula. I've highlighted the formula down here. You can study formula to your own convenience. Same as the index formula. You can use the if, but nested if most of the time. If this particular thing is base case, given this number. If it is best case, given this number. If it is worst case, given this number, right? So that is like so. But these three, I consider them not really dynamic, and I feel like XLOOKUP is quite logical. So this one, yeah, rather than me using the number 1, 2, 3, I'm actually using the actual name um, the assumption here. So base case, best case, worst case. So if I change this also from best case to, let's say, base, right? Sorry. So what I'm saying is that I want my XLOOKUP to look at this scenario selection, right? And look at this range of sales growth, and whatever selection I have here in my scenario selection, it should give me the equivalent amount estimates of what I'm looking at. So if, for example, my scenario selection is base, right? And my sales growth, base, best, worst. So because it's currently at base, that means that I am highlighting the 6%. If I change it to best, it will highlight 10%. If I change it to worst, it will highlight 2.5%. There are also ways where you can play around this one rather than putting it manually. We are going to be using things like data validation to pick each of these. I'm going to do that right now when we go to our Harsha model. So this is just a scenario analysis. This is what we do most of the time for some of the line items when you have an opinion, or sometimes it's also a situation when your team, so your one of your team member is very, very bearish about the stock, about bullish about the company. And when I mean bear bull, I mean the company is a great company. Another guy is thinking the company is not a great company. You can easily prepare a single model that will show the two view of your team member. And by the time you guys argue it out, of course, you read a lot of reports about the company, you read more about the company, you do all of your analysis. Probably at the end of the day, after you've done all modeling, you're about to start writing your report. Someone, the team comes together, probably do a debate on it, and you think that the person that is arguing for bullish is right. All you just need to, rather than starting your model all over again, is to change that, just, use a click to change your model to the person's view, and, your single model will remain the same. And of course, if anything changed, probably like a day, I'm just saying, like a day before your presentation, something happened, there's a news about your company, and it turns out that the other guy is right, you don't need to start, changing all the numbers. All you just need to do is move from that old view to the new view using your scenario selection, and that's pretty much it. I'm going to use one more. I'm going to show you one more tool that you can use as an analyst when you're doing when you're working with what's it called, your model, when you're building your model. Things like, this the developer option here in this case, right? So I don't know if you have your Excel there with you. Most time when you open your Excel for the first time, the developer option, tab doesn't pop up. Like you can see the home tab, the insert tab, draw, etc, yada yada. When you get to the view, it tends to be the, like, I think the last, or help tab. But this developer option has some certain tool that you can use to, that you can incorporate into your model that will be helpful to you. And just to show you the two of it, if you let me start from, like, I don't know, because I can't see the chat now, so I don't know if anyone like has a question on how to get there, or if you don't have it on your Excel sheet or your Excel spreadsheet, what you can do is you can come to File, right? You go to File. So because this is Office 365, you might find it in different places. You might find it in different places. So if you go to Option, under this file, this is my option, and it has popped up. So this is just showing me all the general setting I can do for my current Excel sheet. When we get to modeling, there's some certain things I will expect. I want you to do if you are following me, or if you want to do it at your own convenience before you start building your model. Before we get to developer option, let me just quickly show you some of the quick adjustments we need to make. So you come to formula, for example, under your Excel option, and you can see I have enabled iterative calculation. So basically, I'm accepting that if there is any circular referencing in my model, which we would likely have, I'm saying that Excel should look away from it. Sometimes, some of the circular referencing we tend to have in our financial model are unintentional, are done like you do it because you are not even aware, referencing in your model. Sometimes if you have your enable iterative calculation on, your Excel is not going to flag it as an issue. It's just going to, like, keep iterating and bring out, like, it will bring out the calculation, to bring out the number, but you would have created
Sorry,
some circular
Damilola.
reference
Sorry,
without you
Damilola.
knowing.
Hello, Damilola. Sorry to cut you short. We
Hi,
want
hi.
as many people to
No
follow
problem.
through as possible. So,
Okay.
please, by show of hands, if you have the Excel open, if you're currently where he is, that you've activated developer on your Excel, please just indicate, so we know where that people are following. Somebody is asking if we have to pay for this version of Excel.
Office 365, yes, I tend to pay for it, but again, some of you don't have to use Office 365. You can use the older version also. But in that, everyone would definitely have a developer option if you're using the older version. It's just where to find it, I'm guessing now.
I can't see any hands raised up. Is it that we don't have the Excel open, or we're not where he is? I just want to be clear. Okay, somebody says they're on the same page with you. Akinwumi Adebayo, thank you. Let me just
I didn't hear you.
Somebody says they're on the same page with you, they're on the same page with you.
Oh, okay, good.
Okay.
Okay,
if I
good.
have three more responses, then we can just move. Please, if you're on the same page with him, just indicate, so that it's not, because this is supposed to be a very, very practical class. Okay. Same page. Tracy, same page. Okay. So if you can just, for the sake of the people, just let's just go back to how to include developer to the Excel so that then we can continue with that. Thank you.
Okay, no worries. So let's go back to the developer option before I, talk about circular reference. I'll spend more time explaining circular reference in any way when we get to the our own model. So now back to, if you want to bring out a developer option, so you come to a file, it brings out all the different option, prints, and all, and I think this option is like is here under the 365, but I think if you look at your own older version, it might be closer to the home new open option. So when I click on option, it brings out a pop-up, right? All the general setting things you could a particular spreadsheet is concerned. If you are using Office 365, most of the time you find your developer option in customize ribbon. So if I click on customize ribbon, you can see that it's bringing out, this is the main tab. These are all the main tab: home, insert, draw, data. So this is my developer option. Will most likely be unchecked like this. So I'm going to check it. So checking it means that I want it to be part of when I close this, I want it to be part of the tabs, right? So clicking on the developer option. If you are using an older version, if I can guess correctly, if you go to the advanced option, this advanced option, if you scroll down, you should see your developer option, see a place that would allow you to click on developer option. Currently, if you don't have it, I can look at version of the your society, and can pass the message to you on where you can find it in Excel. Or again, you can easily go on YouTube and type developer option in Excel. I think it will bring out different Excel videos, so you can check where the older version of developer option is. Sometimes usually under this advanced option. But if you can't find it there, if you're using Office 365 or you can probably come to, and I think you can check customize ribbon if you do have it in your older version, and look at the main tabs and check your developer option. So when I click OK, right? Normally, if it was not there before, you will now find developer option. Now, what I just want to show you is just these two things: this pin button and this other scroll bar option. Now, when we start building our debt schedule, right, in our modeling, we want to make an assumption of, like, a company, like we said, will have equity and will have debt, right? If a company has debt, it is obligatory on the company to pay it back at some point, right? So when you want to pay it, the question is going to be that how do you structure the repayment? So let's say in year 0 we have 100 debts in our books that we are owing in the balance sheet, and we want to model out our repayment option. So of course, in year 0 is 100. That means year 1, because it's going to be in your balance sheet, you are going to see this 100 also at the beginning of the year, right? So if we want to assume that in year 1, we are going to pay back all of these amounts, all of this 100 that we are owing, it means that, of course, if the beginning balance is 100 and repayment is 100, then ending balance is going to be 100 minus 100, right? And it gives you, 0. But let's assume that we are expecting to pay it in 2 years. So if I click on this spin button, which has been formatted anyway, it breaks down the repayment for me into 2, saying that I'm going to pay 50 now, and I'm going to pay the remaining 50 in year 2. So of course, there's a formula here using the minimum function, saying that if I'm going to be paying this back in 2 years, so if you double click on this, it says that give me the minimum of, divide this 100, this actual amount of debt I'm owing, divide it by the number of years I'm expected to pay it, right? So, and that is 50, right? But of course, and give me the minimum of that, and the beginning balance of year 1. So this is just to show you that if I am owing 100, right, and I'm expecting to pay it back in 2 years, that means I'm going to pay 50 next year in year one, 15 in year two. What this repayment is just showing is just to capture the fact that I'm not paying all of the 100 in year one. So by the time you deduct 100 minus 50, you have 50, right? If I increase this pin button, I'm saying that I want to pay it back in 3 years. If I increase it by 4 years, it's just to show you how how you can model out your repayments. It could be more sophisticated than this, but this is just something very basic, right? And the question is, how did I do all of this thing? Now let me show you how or what I did. Basically, if you have your developer tool right now, you click on your developer tool, probably you are currently in your home tab, you click on developer, it will bring out all of these different options for you. If I click on insert control under my developer tool on tab, if I click on insert, you'll see different stuff. You see form control, ActiveX control. So you go to your form control, under your form control, spin button. If I click spin button, it allows me, it brings out this plus sign, and I can easily stretch and I would drag. As you can see now, I have another spin button here, but this spin button is currently not active, right? You can see I'm clicking on this current spin button, it's working, right? But I'm clicking on this right now, it's not working. The only reason it's not working is because I have not formatted it to capture this current repayment schedule that I have here. To capture it, you right click on it, you go to format control. Now, it gives me some option, right? So like the sense around this is just the current value. I'm saying that the current value should be 1. Minimum value, I also want it to be 1. Maximum value, because this is 5 years schedule, I'll put it at 5. And I want it to be increased. I want it to adjust by 1. And if I come back to my cell link here, I'm saying that I want all of this setting, I want it to apply to, then I'll click on this repayment years option that I have here. I click on it. When I click on it, I click OK. Okay. When I click on OK, by the time I start clicking on this now, can you see it's working? So it's working just the way this particular one is also working, because both of them are they've been linked to this particular C6 cell. So these are like possible. Of course, like when you're building your schedule, you don't have to do all of these, but these are just, I would say this allows you to play around, not necessarily play around, to see different things that could happen. By the time you're doing scenario, what will happen if I'm repaying my loan in 2 years? If you have done it manually, or you have used an Excel formula, of course, that means that you have to go back to your module and just start adjusting here and there. But if you have used, things like this particular spin button under a developer control, it gives you the opportunity to see the different things that could play out. Now, all of this might be changing and might not make sense to you, but by the time we are linking all of this back into our financial model, it starts making sense, because it has an implication on the income statement through your interest rate. It has an implication in your balance sheet through your balance, the balance in your debt, balance in the balance sheet. It also has an implication on your cash flow when you start looking at the financing activity of your operating cash flow, because it shows the repayments that you've done, it shows the new debts you've raised. So all of those things will start playing out into your model, and your model become more dynamic if you've accommodated this kind of like setting into your financial model. Now, this one quickly, again, this one is also just like another depth model, little like a small depth model that you can use in building scenario. Now, I'm saying that, of course, one of the metric I know probably in your financial analysis class, they must have told you about EBITDA to depth to EBITDA, EBITDA to depth. You want to know how much of your EBITDA can cover covers your debt. Of course, the higher the better, because it means that when the debt holder comes today to say we want our money, you have enough money from your operational activity to pay back the debt. But right now we don't have any leverage. We don't we don't have any debt. Our debt is 0, and that means that the debt to EBITDA, of course, that means this debt to EBITDA is currently like has a multiple of 0 because we don't have any multiple. But by the time I start increasing this, for example, that means that if I'm saying that I have a multiple of debt to EBITDA of 1 times, that means that, and if my EBITDA is 500, then that means that my debt is also 500, right? If I increase it and I keep increasing it and I keep increasing, all of these things are just Excel 2, but it gives me the ability to see what the implication of what happened if certain ratio that is key to analysis changes. Now, the way to go about this one, for example, just like the spin button, is also to go to developer option. Let me just click on format. Let me say insert, come to in, right? Then you have this scroll bar. So if you clicked on the the spin button, or you just need right? If you click and drag, right now it's not changing, it's not making any sense. But if you come here, let me just use this as an example for you. By the time you click on this and click on the format control, it's saying that it's just like the way we did the spin button, right? You put a current value, you put the minimum that okay, what's the minimum of your senior debt to EBITDA multiple that you want to use currently? You want it to be at 0, like minimum, but you want the max should not be more than 10, and you want to be increasing by 1, right? Then you click on the cell link, which is like this C18 cell. By the time you click on it and you click on OK, if you do that for this particular control, it's also going to start reflecting on this. So I think that's pretty much enough on scenario analysis. We are going to do all of that, and we're going to build that into our financial model. So I'm going to stop sharing this particular and I think we can start our financial modeling properly. Before we start, do we have any question? Let me just open this in the meantime. Share screen. And I think.
Question.
There are no questions in the chat. I
Sure
can't
thing.
see anybody hands raised either.
Okay.
So yeah, you can proceed.
Okay, that's fine. So like I said, I'm assuming that we all have the Excel templates. But if we don't have it, that is fine. We can just follow. So this is an Excel template, and we've talked about how to design your model, vertical approach, matrix approach. As you can see, this is the matrix approach where each of the statements are in different, sorry, they're in different sheets, right? So this is income statement, this is balance sheet, this is cash flow. All of this right now are historical. As you can see, 2020, 2021, and 2022 are all historical number. We are currently in 2023. Before I go into the modeling proper, I just want to say, I think there was something I missed the last time that I feel like, you might be thinking about when you are doing your own financial model, because I know that your subject company has reported up until Q3 of 2023. When you want to prepare your model, it makes more sense for equity research guys. So when you're doing equity research, when you prepare a research model, it makes more sense for you to build a quarterly model rather than an annual model. The reason being that the company is reporting quarterly, right? So it makes sense, of course, for you to build your financial model quarterly. If the company is reporting semi-annually, let's say they H1, they do H1, they do H2, then it makes sense for you to build your model semi-annually. And if, in very rare cases anyway, your company is reporting only annual results, then of course you should build your model annually. When your company is building quarterly, I think this is the way it's going to look like, right? So you're going to put on Q2, H1, Q3, 9 months, Q4.
Hello,
Q3,
Damilola.
yeah, hi.
There's a question. Sorry to cut you there.
No,
Tijani Lawal is asking,
fine.
please, how do we create schedule for multiple debts? Let's say a company takes debt every year. How would that schedule be built for such company? If this is something you're going to talk about during the course of the presentation, we can maybe wait until we get there.
Yeah, sure. I think what I have is a simple schedule of debt. But I think to answer that question, of course, what I showed you the other time when we're doing our scenario analysis is just to show you, an example of how you can build scenario into your schedule. But if a company is taking multiple debts, you have to like create, a different you have to create your schedule in a way where you bring out all the different kind of debt that the company has. So if the company has bond, a corporate bond, for example, if the company has a bank loan, you know, the the interest rate, of course, in this case, for each of the debts will be different. So you need to build a proper debt schedule to show the debt for, let's say, the corporate bond. So what is it? What's the interest rate? What is the repayment structure looks like? Then, of course, you do the same thing for your what's it called now, for your bank loan. You model it out. How much is it? When are you repaying? Are you expecting to get another issuance in a particular period? You do all of those things. Sometimes some people will build one, right? They'll build one big schedule and they will do the breakdown. Sometimes some people just they want to make it sensible and logical, so they just focus on one, then they go to the another row down, they do the same thing, they keep doing that. At the end of the day, you need to remember that all your debts, for example, has different they have different interest rates, right? And probably all of them are subject to paying interest. The interest that will be sitting in your income statement is going to be the addition of all of the interest rates that you've modeled out for each of the different debt schedule, right? So if it is like short-term debt, long-term debt, the interest that is going to sit in your income statement is going to be the sum of all of the the debts, the interest on each of those debts, if that makes more sense. So yeah, that's it. But if you don't get it, of course you can like let me know, of course, in the chat box. Probably we can. I think I did something like that for this. I did something like that for capex. The way this capex is designed, for example, will show you, give an idea of how you can model out different when you have different when you have different line item of a particular balance, let's say PPE or debt. How do you capture everything? So yeah, does that
Okay,
answer
thank
your
you. There's
question?
one. Please, if that answers your question, let us know in the chat box. If it doesn't, please let us know. But in the meantime, there's another question. Is the
Yeah.
reporting schedule not consistent for all companies in Nigeria?
To be honest, I'm not familiar with the Nigerian capital market, but I am assuming that there's the NSC requirement of how frequent you should report, and of course, there's some company. I think most of the time, most companies will be very rare for you to say company is reporting probably semi-annually or annually. Most of the time, it's quarterly. But I think Hypad is raising his hand.
Yeah, iPad, please, over to you, Sam.
Okay.
Yeah, sorry. Something I'm unable to log in from my
Okay, iPad is something. Got it.
Okay, so just wanted to. I mean, I have a bit of experience in the capital market, and like confirm that in terms of reporting requirements, companies are required to report their quarterly results. I have said, and I think if you check the NJX, maybe after the end of this, after the end of this session, I mean, if time permits, I could take some time to walk everyone through how to get those reports on NGS. If you check NGS, you should find the annual report, quarter report of each of the target company you're looking for. But the requirement is for them to sort of release and prepare their quarterly report, and of course, at the end of the year, the annual report. And I think alternatively, you can also find some of these reports on the target company's website, if that helps.
Yeah, thank you for that, Samson. So, and I think, I was I was trying to raise this particular point because I remember that when I was checking through your subject company's website, I noticed that just released Q3. So I felt like it's important for me to like let you know when you're building your module, try to do it quarterly. And I think so your Q1, Q2, for example, by the time you add both together, it gives you your H1. By the time you add Q3 to your H1 or Q3 to your Q1 and Q2, it gives you your 9 month result. And most of the time when you're seeing a company reporting Q3, for example, you see them also reporting 9 months. Technically, it's the same thing. It's the same period. And by the time you add Q4 to it, you have your if you had your Q3, Q4, it gives you your H2. Different ways to do it, but point is that by the time you add Q1, Q2, Q3, and Q4, it gives you your annual result of 20 of this particular year, 2020, that I just model out here. The point I'm trying to make here, which is very important for you, most of the time when people want to start building their model in this kind of situation where the company just released Q3, the question is going to be, what do you do to your 2023 results? Some people will analyze it, and I think that is wrong. Right, so analyzing it means that you just pick what the 9 months is, and you divide it by the 9 month, and you get your 1 year result, your 1 year estimated result. This would be wrong if, most especially, the quarterly period don't react in the same business way. That is, if in your Q4 you are not you can't confirm, or you can't really say with certainty that the company, how the company has reported in Q1, Q3, the performance of the company in Q1 to Q3, if you can confirm with certainty that that's what's going to play out in Q4, then analyzing it will make sense. But if you can't give that certainty, then it makes sense for you to start your forecast year from Q4 of 2023. Then, of course, by the time you get to 2024, you do your Q1, Q2, Q3, Q4, and you do that, consecutively up until you get to your forecast, the end of the forecast year. So I just wanted to make that point before we start. So as you can see here, this is our income statement, and I think we've talked about, like, this is the matrix approach. This is also a threaded way of designing the model, where I have my price and I have the percentage growth in between. I have my volume. I have the volume. Some people, like I see, probably in your financial analysis class, or you would have done an assumption sheet when you are preparing your ratio, where you have all of your assumption. I could have done an assumption sheet here where I'll put all of the revenue growth for price, for volume, margin, and everything I have threaded here. I could have just done it separately and link, but because I'm lazy, two, I didn't have much time. I felt like this is just the quickest way for me to, to present it. And of course, all of these are dummy number. It doesn't represent any company's any company's numbers. These are all dummy. It's just me playing around with numbers. So just wanted to put that out. So because I want us to build a scenario analysis into our model quickly. So I want us to do that together. If you are following with me, but if you are not, that's fine. So right now, what I'm going to do is I'm going to go to my schedule tab. I'm going to do that there. I'm going to just put something called, I'll say scenario analysis. I didn't do this before, but I feel like let's just do it together. So I'll do revenue, price, I'll do base case, and worst case, right? I'll do for revenue. I don't know if you can see, if my Excel is if it's visible enough, or you want me to increase it, want me to zoom it?
I think it's okay.
Okay. So revenue, I'll say volume. So then just copy all of this. I don't have to keep typing it out. Right. Let me say I'll do for percentage of revenue. Where's percentage? Revenue. Okay. So let me just pull this to make it look different. Okay. Right. Made an error. Okay. I think. volume. Let's go. Okay. So what I'm going to do again, when you're doing your matrix, when you are doing a matrix model, remember one of the key points we discussed that if you are working with, this is 2023 right now, right? 2023, and it's 2023 here start from G. So if I copy this here and I come to my revenue schedule or my schedule that I'm trying to build, my 2023 here must also start from G, because when I start auditing my model and something is wrong, it has to be G to G, not G to H in another tab. So that way I can know that I'm picking the right here. So this is the base case, right? So I'm going to come here and drop it here. Let me also do the same thing for volume. For volume, I'm going to come here, highlight it, copy it, come back to my schedule here. I'm just trying to create a quick one, paste. My cost of sales percentage of revenue, I have it here as 25%. Copy here, here, paste. Sorry, that's an error. As you can see, I need to like just do a quick format. Now, so let us build our scenario. Let's do our assumption together. Let's say right now we're saying ceteris paribus. This is our assumption for growth on price, on volume, and for cost of revenue. I'm just going to do these three. I'll keep it there. So in my best case scenario, what I'm going to do for all of them, I'm going to assume that if there's economic prosperity, we are going to be seeing this particular base increasing by 40%. In a case of economic downturn, we're going to be seeing this particular base case being reduced by 40%. So what I'm going to do, I'm going to say equal to, right? I'm sure that in your financial analysis, they've taught you how to, do growth rate. So you should be familiar. So I say this, for example, I multiply it by what? So if I'm saying 40% increase, I'm saying that's 1.4, right? That is 1 plus, this is actual formula, 1 plus 0.4. Now, because of course it's not formatted, so I'm going to format it. So this, I will try to like touch on formatting because I think we still have a lot of things to do. So I will try to be fast this time around so that we won't get stuck not completing the module again today. So I'm going to format it. I'm going to come to my, tab, home tab here and just format it, keep it at one decimal. So now this is, I'm estimating that, base 2%, best case 2.8% growth. But in the worst case, it's going to be this, right? Multiplied by what? 1 minus this time around, right? 0.4. Or you can just say times 0.6 because 1 minus 0.4 is 0.6. So I click this, not formatted, and this is it. So now I'm just going to do copy and paste all of this to all of the years, right? I've done that here. Now, because this is not necessarily a formula, this is just my estimate. So I'm going to remove all of this formula from my model. And the way to do that is that I'm going to highlight all of this, right? And I say Control P and Control ESV, like paste special, I'm going to turn it to value. So by the time I click here, I'm removing all of the formula. I know all of you are familiar with, probably a lot of you are familiar with Excel. So like, this is my base assumption. So I'm just trying to keep things very quick. So I've removed the formula. As you can see, it was initially like it has a formula. We increased it by 40%, but now it doesn't have a formula. Let me do the same for this. So I'm going to return it to value. And now it doesn't have formula. So of course, I'm going to keep all of this. Sorry, I'm going to format this to reflect that. Remember that when we're talking about hard-coded figure, it has to be blue. So that is done. So let's do the same thing for revenue, volume, and cost of sales. So quickly, if you are following your Excel, it's fine. But if you're not following, let's just, so 1.4. And this is equal this 0.6. Going to turn this to percentage, increase it by 1. Right? Format it, then That's it. So we've done that. Now for cost cost of sales scenario, remember it is the opposite of what we did when we're talking about revenue. So for cost, my best case is going to be that if I'm doing 25% percentage cost of sales percentage of revenue, if I'm going to be doing a best case scenario, this is going to be 1 minus 0.4. In a best case scenario, that means I'm going to be achieving a higher gross profit, right? And for me to achieve a higher gross profit, it means that I am incurring less, I'm spending less money in terms of like cost. In a worst case scenario, this is going to be, higher. The cost is going to be higher this time around. So I say 1.4, right? So 20 percentage, 1 decimal, create Ctrl R, then format it. Oh, it's still in formula. So Ctrl C, Alt ESV. Sorry. Ctrl C, Alt ESV. Yeah, and that's it. So as you can see. So what I'm going to do right now, I'm going to go back to my income statement and remove all this, right? The way to do it is, let me just remove all of this. Yeah. Let me remove this also. And let me remove this also. Good. Now, rather than putting it directly, I'm going to be linking it, right? So 2023 is going to come from I'm going to pick my 2% here. So when you're modeling, you don't have to pick each of the year. Just do a vertical, just do a cell and copy and paste. So if you've done the right thing, you'll be picking the right number. So I'm going to pick this also from 10% base. Then this I'm going to pick from here also 25% base. Now, because this is no longer, this is a link. So let's keep it as red for now to show that it's coming from an external sheet. So yeah, so since we've done the right thing, right, we've picked the right, all you have to do is to just highlight all of this, then do Control R. So if I click on my control and open brackets, so open brackets is the key, is a key beside your P button in your Excel sheet. If you do control and open bracket, it takes me back to where this is coming from. As you can see, it's coming from 2025, right? So this is schedule schedule I-101. So it shows that it's coming from column I. And this is J101, K101, M101 as it should be. So we are seeing, by the time you start seeing schedule, let's say L101 under M, it means that you are picking the different year. And that could we might have some drama when we start doing our modeling. So yeah, I'm going to keep it at that. Some people will do a very, like I said, they'll do all the scenarios and for everything, but I think this will be sufficient. So here, I'm just going to in an empty cell, I'm going to prepare let me write a base case here. So this is a base case, right? So like I said the other time when I showed you the other scenario, we're literally imputing it directly. So we can use a data validation to just quickly set something up on that side of things. So if you have done a base case here, I can come back to data. I'll go to data, right? Then under your test to column option here, in this particular side of things, when you click on data validation, you see data validation. I click on data validation, right? Under the setting, I'll click on list. I'll choose list here. Since it's a recorded session, you can always come back to it, to be honest. So I'll click on list. Now, the source now is that because what I have here right now is base case, so I'm going to write it down. I say base case, comma. I do. Oh, let me just Let me arrange it. Best case, base case, and worst case. This is the 3 option I want to have. So now, if I come here and I click on, see, best case, I can change it to best case, I can change it to base case, and I can change this to worst case. Now, let us quickly do, let us set it up. Let's set it up. So setting it up means that we are going to come to our, actually, I shouldn't have linked this. So let's remove this. Let's not link it because we want to do our scenario analysis already. So let me what we would do here is that I'm going to say equal to. We're going to use the XLOOKUP, right? Say XLOOKUP. So XLOOKUP is just going to help me to pick the right number. So I'm coming to say, help me to look up base case. This particular cell. So let me look it up. I say comma. Where do I want it to look at it from? I want it to look at it from here. Since I'm looking at price, so look at these 3 options. Look at find base case from this 3 option. I'm going to add code this. Sorry, turn it. I'm going to anchor it and turn it to. That means that don't look beyond this 3 cell. So I've anchored it. I anchored it using F4. If your keyboard has function key, you tend to see that function key beside your control. If it has it, so it has to be function F4. But if you don't have function on your keyboard, you can just click on F4. So it will give you the anchoring option or the $sign. So you can just check anchoring in your Excel like videos and all of that to bring it to explain anchoring to you if you're not familiar. So I say like right, I put a comma and I said if you find base case here in this selected option, give me the equivalent of whatever it is that is here. And I press enter. So it brings 2% because this is a formula. So I'm going to change this to black. Right? So all I just have to do is to just do Control R and something is wrong. So what is wrong? What is wrong is that if you click here, for example, can you see? Because I didn't anchor the base case. So it's not finding anything. It's not making sense. So there's an error. So I press Control Z and I come to this my formula. Then I also like anchor it, right? By the time I anchor it and I do the same thing I did now, it should be fine. So that's pretty much for, and now let's see what happened. Let's just see a quick one. If I change this from base case to best case, it changes from 2% to 2.8. If I change it to worst case, it changes to 1.2. By the time we start modeling, it start affecting all of the number that it is linked to. So let me just leave it at base for now and just set it up. Also this one, I would clear it up and I will do the same thing. So XLOOKUP. So again, find this for me. This time I won't forget to anchor, comma. Then I come to my schedule. And here, I want you to look at the volume, right? So check here, don't go beyond that anchored. And whatever I find, give me the equivalent of it here. And that's it. So now we started linking. So basically this is like the background of like, these are the basis of what we should be doing before we start modeling. So we don't have to like go back to it now and then. So I said this, I do the same thing, XLOOKUP. Find this for me, anchored, comma. I come to schedule, check here, anchored, comma, then this, close my bracket and there you go. So, and that's it. Then I turn it to black because it is formula. So let's start with our modeling now. As you can see, these are in blues because we've not done, I'm assuming that historically, my research and distribution as a percentage of revenue has been 9%, 9.1. Some people do average of it. we've talked about how you can, give an estimate of the future. It may not be 9%. You might have another opinion, and you can put all of that. So I'm assuming it's going to be constant at 9%. Also, my SG&A as a percentage of revenue is going to be 12.8 constantly. It's not too far off from historical, so I think that is reasonable. I'm assuming my company is a very stable company, so nothing is changing so much. So now let's start. So we would start with our revenue, right? So now we know the growth rate of price that it's going to be growing at 2%. So we grow our, financial analysis, they've taught you that. So we say historical was 20, then growth rate 1 plus, or let me start with my assumption, 1 plus this. Either way is the same thing, right? So I've done this. For now, I'm not going to keep dragging everything. I'm just going to do one 1 year and drag everything out. So my revenue, my volume also, I'm expecting it to be equal 1 plus my assumption multiplied by historical year, right? Now, total revenue, of course, is price times volume, right? So but again, remember last weekend, I said you should start linking your historical. You should start working on your historical in a way where, but you don't have to like, start all your calculation from 2023. So if I've done all of that already in my historical, I just need to like copy and paste it, and it gives me the multiple of price and revenue, right? So, and of course, this is to show you what year-on-year revenue growth is looking like. As of now, it is showing 12.2%, which is the combination of my this is growing at 10% and this is growing at 2% because there was no active growth here in 2020. So that was why it's picking up 12.2%. So cost of goods sold, right? So I want to calculate, I'm expecting that my cost of goods sold is going to remain at 25% of my revenue. And since I already have my revenue, all I just need to do is say equal to 25% multiplied by, what's my revenue here? 13,576, and I click enter. And that's it with that. Then of course, gross profit, since I've done my formula, my gross profit should normally be my revenue minus my cost of goods sold. So I just need to like copy and paste it. Or of course, let us not keep copying and pasting everything. So let's say equal to, right, revenue minus my cost of sales. So if I pick the right thing, so this is it's already like that's so I'm using the sign convention I'm using is that I'm assuming that we all know that cost of goods sold is cost. So it doesn't have to be negative. Some people will put negative, right? So let's say, for example, I make this one negative. The correct thing to do here is for me to say equal to this plus this. And of course, when you want to do your formatting, look at the way this negative is here looking like. It's not looking very neat. So what I can do is I can do Control-1 on that cell. It brings out like this. I don't know if I'm guessing the financial analysis class would have probably like show you a few of this. I like using. So if you just go to custom under what I just did, like Control-1. So if we scroll up, you can see general, zero, this and that. This, for example, is showing you that before the semicolon, the first part is showing that if the number is positive, this is what it's going to look like. If the number is negative, this is what it's going to look like, right? If I click on OK, as you can see, the negative is now looking like it's making more sense. If I don't want negative, this kind of negative if I don't want minus as a way to show my negative, I can come back here and click Control-1. Where is it? Something is wrong. Okay. Here, for example, I'm saying that my negative should be, if my number is negative, it should be red. It should show as red. It should show my negative sign, but it should show as red. This is just all formatting. If I don't even want that, and I want, let's say, anytime you see negative, I want it to be bracket. I can come here. Let me just play with one of the numbers here. I can just choose one of these. This is after the semicolon. And I can put brackets equal. So these are different ways you can show your numbers, right? So I'm going to keep it at this one. I think this one is better way. But I don't want to use negative sign, right? I prefer using, and in that case, that means that this is going to be equal this minus my cost of goods sold, right? Okay. So my gross profit margin here, I'm just copying and pasting it. So I can just say gross profit margin is gross profit divided by, right? Divided by revenue. Either way. So research and development, I've already we've kept this constant at 9%. All you just need to do is this multiplied by what? 9%, because I said it's going to be 9% of revenue. So 9% of revenue. SG&A, 2.8% of revenue equal this multiplied by 2% of revenue. And you have this. This order, I'm going to keep it at constant because we never had anything anyway. So I'm going to just equal. And sometimes you have this kind of stuff in your book. Sometimes you can't model it out. So just keep it at 0. And I'm going to keep it at 0. So I'm going to sum this up. I'm copying and pasting from this historical because I've already done what I should have done. So basically, I'm saying that my total operating expenses is the addition of my research and development, SG&E, and other, right? And this equity in earning of unconsolidated affiliates, all of this is if your company has subsidiary. So the kind of line item you are going to be seeing. Your EBITDA, of course, EBITDA, like we defined the other day, is our gross profit minus our total operating expenses before depreciation. We've not factored in depreciation and amortization. So I'm going to copy it again. EBITDA margin. Let me not keep doing copy and paste so you understand how I'm doing certain things. So EBITDA divided by revenue. Now this is not looking correct. Okay, it is divided by, not multiplied by. Right. So my depreciation and amortization, I'm going to leave it for now because we have a schedule for that. Most of the time, depreciation, we tend to model it using our PP schedule. And we want to look at how much asset do we have, how much number of useful years do they have? Are we buying more assets? How much are we depreciating them? The addition of all of those things, then we look at the addition of all of this, each of those different PPE, total depreciation, then we bring it here into the income statement. So EBIT, of course, so because since we don't have, our EBIT should be EBITDA minus depreciation and amortization, right? Because we still don't have it, but even though we don't have it, let's still put the formula there. So it's going to be EBITDA minus depreciation and amortization. I click on it. So as you can see, this is pretty much the same. You can easily just copy and paste if you've already done all of that formula in your historical number. So EBIT margin, of course. So right now, your EBITDA and your EBIT is the same thing right now because we don't have depreciation. But that will most likely not be the case by the time we start, by the time we bring in our depreciation and amortization, right? So interest expenses and interest income, this one also, we'll leave it because we are going to be building a debt schedule. I think it comes back to Tijani's question. So by the time we do that, by the time we do a debt schedule, the total of the interest is going to be what we bring into the income statement. So the net interest expenses, of course, should be interest income minus interest expenses. I think I use the sign convention here, which is not consistent. Okay. What should I do now? Let me remove this to be consistent. I'll remove this. I'll remove the sign. I think one of the things that you should stick with is once you have a particular way of doing something, you stick with it, and you have to stick it so that you won't start seeing different things everywhere. And of course, your net interest expenses now should be that it can't be sum again, so it will be this interest expenses minus interest income. So yeah. Okay. So we have that. So of course, I'll just keep the formula to this first year we are modeling. It's going to be 0 now because, as you can see, we don't have anything there. And your earning before tax, right? Earning before tax is like your EBT. That is, we've deducted. We are going to be deducting interest without deducting tax. So it's going to be equals this minus the net interest expenses total. It's just the way I designed the model, so it doesn't have to be like that. Let me just, what's the EBT margin before I start talking about tax? So the company's effective tax rate, which is usually the formula income tax divided by earning before tax. So this is it, like the income tax. So as you can see, like over time, that's been between 35% and 34% range. So I kept it at 35%. So if you have it, if you're expecting like it to be around the same range, so you just need to, since you have your EBT already, all you just need to do is multiply it by the effective tax rate that you've estimated. And there you have it. You have your net income from operating operation, right? From continuing operation rather. So that's going to be the difference between your earning before tax and your income tax. So since I already have that formula, I copy it and paste it, or you can just do this minus this. I'm going to keep all of this the same because nothing is happening there, so I don't want us to waste time. Control D. Let me still leave it for now. The sum of it is this, and my net income, of course, is going to be the addition of when you deduct this net income from continuing operation from all this non-recurring activity, you have it, and which is what is here, as you can see. So I'll just copy and paste here. So income to minority, we don't have any. We have not been paying any minority share, and this I believe your subject company is also like a subsidiary of another parent company. So you may not likely not be having this in your books. So of course, I'll just do 0% minus just to put in the formula and be consistent. It's going to be 0. Dividend paid. Of course, this is a very, very random estimate. So I'm saying that they have been paying 80 for the past 3 years. I'm thinking that going forward, the company is also going to keep paying, 80 going forward. I'm sorry, the dividend per share is 0.08. So I just need to multiply that and get my. So here, this is the average. This is the number of. This is the share outstanding, right? 1,000 for basic, 1,005 for diluted. So this is the number of. So by the time I'm saying that my dividend per share is 0.08, and I multiply it by the total number of share, I'm expecting to pay 80 in dividend, right? And net income after dividend and minority. So you minus it from this and dividend, right? And there you have it. So now technically we are done with one year. And the best way to do it is that you can just easily copy all of this here that you've done. You copy this year, right? This is where we got to copy this year, and you can highlight all of this and do Control R, and you have your income statement technically ready, other than depreciation and interest expenses. So before I allow any question, let's do this. Let's do this earning per share. So your earning per share, right, should be what? So your net income divided by the number of outstanding share, right? So I come here. Let's just do that. So we already have our net income divided by the number of share outstanding. So if your company has some diluted share, maybe preference share, convertibles, and all of that, so probably we are saying expecting like a diluted share of the number of shares to increase from 1,000 to 1,500. And what that means is that if you have that kind of situation, this is where your diluted your diluted EPS will look like. So I did the same thing for this, copy and paste, and that's it. So this is like the income statement is like technically this is the first step. So if you have any question, I think let's capture that before we go to the next thing. Any question?
Hello. Yeah, there are some questions in the chat box.
Okay.
Somebody is asking how you formed the assumption of 40%. Is there any rationale to it, or it's just a random number?
It's just a random number. I think last week we spent a lot of time talking about how you think about making assumption, how you think about estimating and all of that. So I think today is just us actually doing the mechanical aspect of it. So there's no rationale. I think when you say 40%, 40% of what exactly?
When you were making the assumptions for the scenario.
Oh, okay. No. There's no rationale. So the rationale is just that, in a better economy, if I'm expecting if I'm expecting growth rate of 2%, I'm expecting that it's going to this growth rate will increase by 40% in a better scenario. And in worst case scenario, this growth rate is going to be lower. So higher, lower, just to keep things constant, I just did 40% increase, 40% lower.
Okay.
So as you can see, this is a base case scenario. If I change this from base case, so let's look at what's our net income for. Our net income in 2029 without factoring in interest and depreciation right now is 9286.13. If I change this now to a best case scenario, of course, I will expect a better net income. So my net income has jumped from 9,000 to about 15,000, right? And in a worst case scenario, if I come here to worst case scenario, my net income has come down from 9,000 to 5,000. So this is just to show you how dynamic your model can be if you are factoring scenario. And this also help you to highlight the key risk that could happen to your valuation by the time things start changing. If growth rate is down, if this is up, what will happen? So right now I'm going to keep it at the base case. Any other question before we move on?
Yes. So it's an Excel question actually. She says she wants to try the XLOOKUP formula on her Excel, but she's only seeing XIRR, XMPV, XOR. What does she do?
Yeah. So in your case now, I think we already talked about it that some version of Excel may not have XLOOKUP because XLOOKUP I think is for very new version. And I'm currently using the Microsoft 365, which is like the new version of Microsoft. So I think you may not have XLOOKUP. If you don't have XLOOKUP, there are other ways, right? So you can use the index formula. I think I would send after our first break, I'm going to send the scenario sheet, the scenario sheet I was showing you the other time. I'll send it to the organizer. They'll share with you guys. Then you can look at the other options that you could use. So you can use the if, you can use index, you can use index and match, you can use choose, you can use different kind of Excel formula. All you just need to understand is the logic behind what exactly are we trying to achieve. So once you get the logic, then I think should be fine.
Okay, still another question from Tracy, still on Excel. She wants you to go over the insertion of the cases scroll bar.
Okay, the scroll bar. Scroll bar. I think I'll have to. Okay, let me just do it here. So let's say I have the developer option here, right? So you come to insert, then this is a scroll bar. So I click on it and I drag. Let's say I want this 10% whatever to keep increasing. Let's say by 1%. I want to see what will happen to my growth rate here. This market growth. Let me just highlight this. It's just for you to understand the logic and you can play around these things. So this is market. This is what is driving this particular the market growth link. So if I want to see what will happen to my market growth if this changes between 10% and 15%. Now, what I would do is, I already inserted this, right? But it's not functioning right now because I've not done anything to it. So I'm going to right click on it. I click on format control. It brings out this pop-up. Now, what I want is that the current value, I want it is at 10, right? 10%. So I put 10 here. I say 10. Where's my number? Something is wrong. Okay. Maximum, I'm going to keep it at 15. Something is going on with my keeper. I don't know what is it, but so I'm just going to, let me just play around this quickly. Hopefully. Okay. Let me copy and paste this. So my current value is currently at 10, right? So the minimum value, I also want it to be 10. I don't want it to go below 10. Maximum is 15. I want it to be increasing by 1. The cell link, I want it to be this. This is what I want to be moving. I want to use this particular scroll bar for. I click on OK. Now, oh boy. So I think it's formatting. Let me keep it at. I know what's going on. The current value should be 0.1 because it is. Why is it not working? I don't know. Okay, what can I do? Okay, it's working now. So I go back to my format control. Because it is in percentage, so it was not picking the right 0.1, right? So 10, 15. 0.15. Okay. Something is. I'm coming. I'm just trying to get the formatting right. Minimum value. Incrementing by 1. Want it to be this. Okay. Whatever is going on with this stuff. But let's just play around it. Let me keep it at 10%. Okay. So if I move this right now, the formatting is not changing. There's something wrong with the formatting, but if you keep changing this, it's changing by. Okay. Let me do the right thing. 1. Should be the right thing. Oh, let's see. Maximum. Then okay. Still the same measure. Okay, keep it at 1. Let's keep it at 1. Minimum, let's keep it at 1. Maximum, let's keep it at 5. Okay. Okay, it's just the percentage formula thing. But if I keep moving this now, it is active, right? It's changing by, it's changing in an increment of 1, right? So this is just for you to show, this is just to show you how this market growth is going to be increasing and decreasing based on a range that you've given it, right? As you can see, it's changing. So I don't know if you are not familiar with it, or you want me to go back to show you how you format this or how you insert this. Let me know. In the meantime,
Hello, Tracy. That's to you. That's for you. Is that okay? Okay, Sasha has gotten it. Thank you.
Okay, cool. Okay, cool. So now the income statement is done, right? Before we do the balance sheet and the cash flow, the balance sheet and cash flow, we're going to let's do our supporting schedule. So some of the things that we will need to have done before we start, putting in the balance sheet figure and the cash flow figure. We are done with the income statement technically, except for the depreciation, interest expenses, and interest income. So let's go to the schedule. Now, in your schedule right now, there are certain things like, so let me bring in the revenue here because for some reason I'm going to be needing it to do my analysis. So the revenue, of course, you're not picking, don't pick 20, don't pick 500, you're picking the actual revenue, right? D10. This is 2020. And as you can see, it's 2020 to 2020. And I'm keeping it in red because I've built the model before. I just have to like delete it. That's why you're seeing that the format is already there. But normally because it's coming from income statement, so I keep it at red. So Control R. So my PPE on 1st of Jan 2023, that is my opening PPE. No, these are historical. From 2020 to 2022 are historical. 2023 is the first forecast year. So if you go back to my balance sheet, as you can see, historically I've added all the numbers. These are all the numbers just to repeat it. So this is the historical, right? So and this is 2023. I'm saying that in my balance sheet, my PPE right now is 5275, right? But if you come to this is the closing balance. This is the PPE value as at the end of 2023. So at the beginning of 2023, of course, this is going to be the balance because the balance at the end is what you are going to bring as the beginning. So of course, what would make it to change are things like what? Your CapEx, you are buying new assets, disposing assets, and of course your depreciation. So your depreciation of the current assets that you still have, the adjustment from your disposed asset, and your depreciation value, based on the available asset that you have. So those are the things that will make your your PPE to change. But we can't do all of that. We can't showing that breakdown will make more sense, and that is why we tend to build schedule for it. And so my opening balance of my PPE, I'm going to bring it from my balance sheet. So for 2023 opening, it has to be the closing balance of 2022. So this is the right figure. I'm also going to change it to red. So now I'm assuming that, back to Tijani's question, this is something similar. Your CapEx for each year, I'm assuming that in 2023, I'm going to buy an asset that is worth 1,000. In second year, I'm going to buy an asset worth 500. In 2025, I'm going to buy assets worth 750. What that means is that the depreciation that you're going to calculate as at 2023 is going to change by the amount of assets, as the amount of capex that you are buying as at the end of 2023. I'm assuming that the value of the asset that you have as at 2023, the beginning of 2023, it has a remaining useful life of 10 years, right? So, and also I'm assuming that every asset I buy from then on also has an asset and a value of 10 years. It may not necessarily be the case. So this is where you have to do your own adjustment. This is where you need to play with your own numbers and all of that. So now, if I want to calculate my depreciation now, I'm assuming I'm using a straight line now. I want to calculate my depreciation, right? So the first thing I'm going to do is that the existing asset, this is existing PPE is 5275. You have to depreciate it. And we're assuming that it has a useful life of 10 years. So I'm going to say this divided by 10. The 10 is just right up here, right? Enter. But the thing is, in 2023 also, I bought a new asset, right? So I'm going to depreciate that too, divided by 10. So that means that as of 2023, my total depreciation is equal to this plus this, right? But to make it more dynamic, I'm going to use this sum function, and I'm going to cover all this so that I can drag the model. Now, circular referencing. What could happen is that I'm asking this particular thing to sum it from G11, which is existing CapEx, to G18. A potential mistake or error that could happen is you dragging it up until G19, which is the total of the total book depreciation. By the time you click OK, let me just click OK for now so that you can see. This is, I don't know why it's not allowing me see what I want you to see. Let's say let me these are the things that you need to do before you start your modeling. Come to option. I think I was explaining that before we got cut off. So formula, it is currently showing enable iterative calculation because I have this button checked. If I click on OK, it will not bring out a circular referencing. Now look at what's going to happen. I'm just going to say, I'm going to take it to like 19. Can you see? It added it, but it has iterated so many times because it is adding the actual, this two depreciation, and adding the total of that two figure. It has iterated so many times and it's giving me a balance of 62,750, which is definitely not correct. But of course, like if you are modeling and you're just like very fast and everything, you won't see it and you won't know where your error will be by the time you're done with your modeling because you don't know what exactly is happening. And that is because my iterative calculation is on. If I just go back and I come back here and I remove my iteration, which is something I would advise you to do when you just start your module. If I click on OK, if I do the same thing, but if I make the same error, I come here, I say 19, it's going to flag it to me and say there are one or more circular referencing where a formula refers to its own cell, either directly or indirectly. So if I click on OK, it's not going to calculate it because it is an error. It is a circular reference. We will do circular referencing in dev schedule. You can avoid it, but sometimes for the sake of accounting way of repayment and all of that, people tend to allow circular referencing when we are doing dev schedule. So I'm going to just show you. And I'm doing this because I want to drag this down. I don't want to keep doing some of this, some of that every now and then. Right. So of course, if it's going to be a straight line depreciation, that means that this existing asset, I'm going to keep paying for the next 10 years. This is not up to 10 years. This is just 1, 2, 3, 4, 5, 6, 7, right? So, okay, I didn't anchor. Let me anchor this. Okay. So that means that this existing depreciation, existing asset, I'll keep depreciating it up until this period of my forecast here. 2023 capex. Also going to drag it. Of course, before I drag it, I'll anchor, right? Let me anchor this period so it doesn't pick the wrong number. Anchor it there. Yeah. So I don't want to keep doing some of, but this is just for 2023. But in 2024, I bought another asset worth 500, right? So I'm going to capture that depreciation of that 500 by divided by the number of useful life, which is 10 years also. So I'm going to anchor it divided by 10. So that way, as you can see, the 2023 depreciation was 627.5, but 2024 I've captured an additional depreciation and it has moved from 677.5. So, and of course, I'm going to drag it down because I'll keep depreciating anyway year on year. Same thing applies to 2025. So I'll keep doing that up until the point where I capture all my capex that I'm expecting that the company is going to purchase during my forecast year. I anchor it divided by 10. So just like that, equal this. Okay, sorry. This captured anchored divided by 10. This here equals this new capex also. I need to anchor it divided by 10. Yeah. Then equals this anchor divided by 10 captured. Then this Anchor it divided by 10. And that's it. So this is pretty much what the depreciation is going to look like at the end of this particular period. Oh, okay. I think I'm missing something. Oh, I'm definitely missing something. I think I made an error. Because it's not should be this should be the last year. Divided by 10. Okay. Yeah. Do we have any question regarding this simple depreciation schedule that we've done? Because now that we are done with the depreciation, we now have our depreciation 1, we have our capex 2, right? So we have an idea, and of course, I just want to look at the percentage of revenue here. Let me see, to calculate percentage of revenue. This is just one of the, probably when you're doing your ratio, you want to look at, what's the percentage of your capex to revenue, just to understand how much of capex you are buying and how much of revenue you are making as a result of that particular asset. So this is just for ratio analysis sake. I keep it here. So on average, I'm having about between 4% and 4.6% of my revenue is my capex. So if there's no question, I'm going to go back to my
There's a question, actually. There's a question.
Okay.
The question is from Tijani Lawal. Hi,
Okay.
Dami. I've seen a company that didn't report EBITDA and depreciation as line items on the income statement. But checking notes, I found depreciation added to cost of goods sold. Looking around, I still find same depreciation on notes, but this time referring to the depreciation reported on the balance sheet, but different figures under the ones under cost of goods sold. Can you please shed some light?
Okay. I think in the last weekend we were talking about depreciation and why you might see depreciation in cost of goods sold. I mean, there's some kind of assets, let's say some plants that you have that you produce from, and you can directly link the sales of that particular product to that plant. You tend to see depreciation of such plants in cost of goods sold. It doesn't have to be cost of goods sold, but I'm just saying it is a matching concept, right? So it makes more sense to present it that way. But most of the time, there's some other kind of asset that you have that are not necessarily directly, related to your revenue. And in that situation, we tend to put it as part of our other operational costs. If you look at that note to the account properly, if you go to your cost of goods sold, you are seeing a depreciation, which is fine, right? But if you are seeing a different figure on your balance sheet, it also means that there is an additional depreciation that you're not capturing that is broken down into the other operational costs. Probably it could be in SG&A note. It could be in, I don't know what the line item looks like, admin and all of, different line items that the company presents. If you look at the other costs, other operational costs, and get their breakdown, you will notice that there are some additional depreciation, and that is why the depreciation in your probably that they break down, because normally depreciation shouldn't be break down your balance sheet anyway. But let's say they give you a balance, they show you a figure in the balance sheet. If you look at that figure, it is the addition of all the depreciation in the books. So it is the addition of depreciation that is allocated to your cost of sales, plus the other depreciation that has been captured in other operational costs. So look at that note to the accounts very well. Look at, study the financial statement very well. By the time you see the other depreciation and you add them together with the current depreciation that is in the cost of goods sold, it will tally, it has to match. If it's not matching, then of course, I'm assuming that the auditor they've done their job and it's not creative accounting, but I will expect that there's the other leg of depreciation is somewhere. I don't know if that answers the question, Tijan.
Tijani, please indicate if that answers your question.
So
otherwise, we'll just have to move on.
Okay.
Okay, please, Dami.
Okay, good. So in the meantime, like since we now have our depreciation figure and you can put that already into our depreciation. So I'll say equal to, right? I come back to my schedule here, then I click on 2023 because again, like I said, what's going on? Enter. So that this is going to be, let's keep that red so that we know that when you see it in your, when you're looking at it, you know that it's coming from an external like sheet. So if I'm looking at my 2023, this is my 2023 as G, right? So my assumption confirms that I've picked the right depreciation of, I've picked the right year as my depreciation for 2023. If it's showing schedule H, it's either you've not set it up correctly or you've picked the wrong year. So that's just a quick sanity check. I'm going to have this here. So I've copied and pasted so that way I can, let me remove this. Let me remove this. Okay. Okay, so what we have left as far as income statement is concerned is our interest expense and interest income, which we'll get to when we start doing when we build our debt schedule. So we've done one bit, right? All of this thing will flow into cash flow, will flow into our balance sheet. Right now, what we have for both cash flow and balance sheet are historical number. And like I said, I think logically speaking, it makes more sense for you to drive your balance sheet through using the cash flow. Sometimes some people will prepare the balance sheet before the cash flow. Normally when we were still in school, when we are preparing our income statement and balance sheet, our three statement financial accounts statement, when we are preparing our three statements, we tend to prepare income statement first. They'll give us additional information, prepare a balance sheet. Then from there, you start doing your cash flow. But logically speaking, when you're modeling, it makes more sense for you to use your balance sheet, to use your cash flow rather, to drive your balance sheet, because your balance sheet most of the time is showing you a lump sum of money that probably is being driven by different things, right? Let me come here. So the quick example will be your PPE and your retained earning. So in your PPE, for example, the difference between 5275 and 5250 will have reflected additional capex, any disposal, and depreciation. So if I just pick these two, if I just look at these two number and probably come to my cash flow and just pick the difference and say this increase is as a result of additional capex. I may be wrong. I will most likely be wrong. And because the cash flow is also broken down in a way where there are some kind of expenses that should go to your operating activity, there's some kind of expenses that should go to your investing and financing, I wouldn't be placing the right number in the right places. So it makes more sense for you to do the breakdown in cash flow, then come to balance sheet and put it together. Same thing applies to your retained earning, for example. Your retained earning is most likely, sometimes it has more line item, but the common one is your net income and your dividend. So this difference between 2021 and 2022 will most likely have reflected your additional net income that you made in 2022, and most likely maybe any dividend that was paid or any repurchases. So return earning, could, even though this one, for example, has a line item for a purchase, treasury stock, it could be, let's just stick to dividend. So if dividend was paid, it's most likely affected your retained earning. So it's logical to drive cash flow. So we prepare our cash flow first before we prepare our balance sheet. That's my point. But before we do that, we need to prepare some schedule to support, say for example, your cash flow statement, our receivable, we need to model our working capital, right? And our working capital, since we're not preparing the balance sheet first, then we need to probably prepare it separately, then bring it to our cash flow. Then from there, we link it to our balance sheet. So let's pick up on, let's continue on the schedule. So we are done with the first schedule, which is like the depreciation schedule or the capex schedule, whatever you call it, or PPA schedule. Let's do the working capital. Most likely, it's usually like the next thing you should do. So here, since we have our revenue, cost of goods sold, SG&A, remember last week when we were talking about links between the three financial statements, I was giving an example of revenue, receivable, the relationship between revenue and receivable, revenue and cash, payable and cost of goods sold, and all of that. And this is where it plays out. I think if you're on Twitter, if you're very active on Twitter, you probably like, I was following some Twitter news or Twitter trend. I think it was yesterday or day before yesterday, where some people were arguing about revenue and loan, which was quite ridiculous. But understanding that you have some relationship between line items will make you understand what should be classified as what, one. And at the same time, it will also like help you to probably use, the relationship to use that, you leverage on that relationship to estimate what a particular line item should be. So since we've talked about revenue and accounts receivable, for example, and I'm sure that in your financial analysis, you've done ratio analysis, right? You've talked about, receivable days, payable days, asset turnover, you know, and these are the kind of ways you can use your ratio to bring back you can use your ratio to estimate what the next line item, what the next number would look like for each of the line items. So in your current, I'm going to be using day receivable, inventory turnover days, and this it should be this prepaid, this prepaid pay, this prepaid, like it's just prepaid in terms of like number. I want to look at the number, how long it takes me to make my payment for prepaid expenses. I'm going to use that for my current assets estimates, and I'm going to use like days payable for my accrued expenses, accrued salary and accounts payable. It is ratio, right? So if you study a ratio, you probably like you'll be able to follow through. But of course, because all of this thing has a relationship with, we are going to be the second relationship when we're thinking about as far as the ratio is concerned, is coming from revenue and cost of sales. So and SG&A. I'm going to be bringing all of that since we've already modeled it out. I'm going to bring it out first. So revenue, for example, maybe when I do it, you understand what I'm saying. Revenue, for example, equal to, so 2023, right? I come to my income statement. I already did. We've done that together. So I click on revenue, right? So I keep it at red, just to show you that it's coming from another sheet. Cost of goods sold. I come to cost of goods sold. I pick the right number, right? SG&A equal to, I come here to my income statement and I pick the right number. Okay. So since we've done that for all of the forecasting, so I just copy and paste anyway. Easy. So now, okay. So we are saying that the formula for current days receivable. So we're talking about receivable. We are saying that we have a certain amount of receivable, people that own your debtors, they are owing us, right? And we expect them to pay back in a particular period in time. Historically, for this company, it takes about 45.2, about 43, 45 days for the debtors to pay back their debt. And the way to calculate it is that you say that receivables, how much are they owing me? What is the total number of sales I've made? I say that receivable divided by the revenue, right, multiplied by the number of days that we tend to use in a year, which is usually 365 days in a year. So if you say receivable divided by revenue times 365 days in a year, we are estimating that it takes about 45.2 days for the payment to be made. So in that case, right, we are going to make an assumption of the number of days we expect the company to like get that debt. Let's say, because since the company is a very stable company, I'm going to say that let's keep it at 45 days, right? So I'm going to, this is an accurate figure. This is my estimate. I'm saying that it takes about 45 days, for the company to receive their money. So let me keep it here. So if that is the case, and I already have a revenue of 13,576, right? So if I want to like do a work back to know the number of to know what the receivable is going to be, if I am going to be to know the number of what the receivable is going to be, if I already know the number of this it takes me, and I already know the revenue, so I'll say that equal to, this is my revenue, right? So revenue times this. Let me see. Divided by 1673. So let me let's so that I don't confuse people that are not familiar with the revenue. No, receivable. Receivables divided by revenue times 365 days, right? If I know this, if I know the days to be 45, right? And if this is the formula, right? Receivable the divided by revenue times 365 days is going to give me, if I know that that's going to give me 45 days, right? And I already know 45, I already know my receivable. So what I'm just going to do is that I'm going to, cross multiply, right? 45 times revenue, which is what we did here. So 45 here times the revenue, then since this is receivable is X, so when you divide both sides by 365, you have your estimate of account receivables. I don't know if that makes sense to anyone, but if I've confused you, you can, when we have the completed model, you can look through it and probably that will make more sense. So inventory turnover days. So of course, when you think about inventory, are you going to be thinking about revenue or are you going to be thinking about cost of goods sold? I know, I know this is like, I'm not getting the feedback right now, but you most likely be thinking about your cost of goods sold because inventory and cost of goods sold, like you want to know, okay, how much inventory do I have? How much did I sell from it, right? That's the relationship. So if I'm going to be doing that too, let's keep it, historically, it has been between 35 days and 39 days. So I'm going to keep it at 35 also. This is just an assumption. So it takes the analyst in you when you're doing this competition to then give a reasonable estimate of what you think. And that is what's going to make the difference. So I'm going to keep it at 35 days, right? So I say equal to also like just this way, but this time I'm not going to be using revenue. I'm going to be using cost of goods sold. So I'm going to say equal to this number of days since I know it already multiplied by the cost of goods sold. And I'm going to divide it by the 365 days. Let me just, then it shows 325.5, right? So the thing is, let me anchor this because by the time I start dragging it, so it won't, so 365 days, for example, is just one. I will anchor it. I'll anchor this also, F4, okay. So for this prepared, I'm also going to be using my cost of goods sold because I'm just, I'm going to be using my SG&A because prepayment, like prepared expenses, when you think about prepared expenses, think about probably rent, factory rent, your shop rent, and this prepayment means that you've paid in advance, right? So, and for accounting principle across, since you've paid in advance, you're still going to recognize it because it's an expenses. So I'm saying that like if I'm looking at that relationship between my prepaid expenses and my total SG&A, my total SG&A is like the other operating costs I'm incurring, like admin, sales, marketing, and etc. So how many days does it take me, to make that money when I'm looking at my total SG&A that I incur every year? That's what ratio does. It's just for you to see the relationship. As long as it makes sense, there's a high chance that if your SG&A is increasing, probably your prepaid expenses also like going to be increasing by a certain amount. It may not necessarily be linear, but there will be a relationship, right? So I'm going to keep this one at 30 days. Say like year on year, most likely about 30 days it takes me. So do the same formula equal to, right? This times my SG&A. Since I already know my SG&A, we already modeled that out in our income statement, right? I divide it by 365 days. I'm going to anchor this 365 days. And that gave me 142.8. Other current assets, because we've not had any value for it in the past year. I'm going to just keep it at 0, right? So, and of course, for me to sum it up, because I have put my assumption are in between my line item, so I can't just do sum of everything. I have to pick the line item one by one. And if you look at the formula here, also I've done the same thing. I've picked each of the values. So since I've done, let's do it together, equal to this, and that is the, let me say the cons of using a traded assumption, plus this plus this plus my current asset, and I say total, right? So now that I have 1 year, I can easily replicate, just copy and paste. And if you've done the right thing, you should have this. So now what the implication of what we've done right now is that we have our current asset, right? So we already have value for in the balance sheet. Now the account, where is it now? My current asset now, my account receivable was 1.5. No, so now I have the value for all of this because in my schedule, we've already done that, right? We've done that. This is it. So we can easily start linking, or you can finish first and start linking, whatever one. So I like doing one bit first, then go to the next one. So let's do the current liability aspect. Okay. So now for current liability, days payable, it has been between 17% and 20.4% over time. I'm going to keep it at 17 assumption. Let's keep this one at 40 assumption. Also, this has been 0 over time, so keep it at 0. So let's do what we did, just like, So now, when you think about account payable, are you going to think about revenue, cost of goods sold, or SG&A? Accounts payable, because this is something that you are incurring as a result of probably being in business. This is operational. So you're going to think about your cost of goods sold. You must have bought something, probably inventory. You purchased something and you've not paid your supplier, so you are owing. So this will most likely, the relationship of this payable is definitely with the cost of goods sold. So I'm going to say equal to this. Please let me know if I'm too fast. If you're not following, let me know. If I'm rushing, I know I'm rushing because I'm trying to ensure that we finish this class today. But if it's becoming too much, or I know a lot of you are probably following anyway. But yeah, let me know. So this times this, I'll say cost of goods sold, right? Divided by, I'll anchor it to my 365 days. And that gives me a number. Then I do the same thing for my accrued salary and employee benefits. I won't link this one to my cost of goods sold because it is more of the other operational costs that are not directly related to me selling they're not direct costs, they're indirect costs, but they're also operational costs. So I'm going to look at SG&A, just like we've done for prepaid expenses. So I say this times, come to my SG&A, I pick it, and I divide it by the number of days, and I anchor, and that's it, right? So now that since we have the number, so we can easily say we can sum it up now. So the actual expenses are not the assumption. So this is it. And now that we have the number, I can copy and paste it, right? So now that is it. Now, so basically, when we are talking about working capital, you notice that I have not factored in cash and debt, right? And that is because cash is not necessarily is cash is cash. So something once told me some years ago, cash is actually cash. These are the account receivable, inventory. These are current assets. These are the things that you have sitting in your book as a result of the operational day to day. So we don't look at cash here. So when you're thinking about operating working capital usually exclude cash and debt. So debt we'll do that separately. And when thinking about it from a cash flow perspective, you most likely know that while account receivable should be in the operating activity of cash flow, cash, for example, and things like that should be on the financing side of things. So total operating working capital. So when you think about working capital is usually the excess of your current asset minus current liability. But operating working capital now has excluded cash and and debt. So, and again, so that I don't confuse you, everything you are seeing here in this current asset and current liability is everything that is coming from your balance sheet. So I've picked everything here apart from cash, and I've picked everything here under current liability apart from short-term debts. Okay, so just for you, so you know that you're capturing everything. So now, operating working capital should be the difference between your total current asset minus your total current liability, right? So here. So another way to look at working capital is that if this is what you are owing 348.5 total amount you are owing right now, excluding debt, and you have about 2,142 in receivable that you can easily get and probably convert to cash. So that means that you have more than enough in current assets to cover all your current liabilities, right? So from an efficiency perspective, this is good. From a liquidity perspective, this is also like good. So what this means is that if you are looking at the total, when we get to cash flow, right? We're talking about how the changes between the current assets, like what does it mean from a cash flow perspective? The changes in current liability, what does it mean from a cash flow perspective? If I'm going to let's just use the example quickly and get that bit out. Let's say that you have a receivable of 1.5. Somebody is owing you 1.5, right? And now your receivable has increased from 1.5 to 1.673. From a cash perspective, do you have more cash outflow or you have a cash inflow? Is this a cash outflow or a cash inflow? So now, the way to think about it is that if your assets generally, either current assets or current liability, if it is increasing year on year, it means that you are spending, money is going out. I will come back to this people. Let me use PPE. If your PPE say is 1.5 and PPE is now 1.673, that means that you've purchased more PPE, right? That means that there's an outflow of cash from you in purchasing the PPE. So an increase in assets is generally an outflow, right? So from an account receivable perspective, the money you're supposed to receive, somebody is supposed to pay you. Now the person is even owing you more. Like the money that you now need in running your operating activity is now even like you are not getting it. So generally, assets increase means that an outflow of cash, right? And reverse is the case. So if your PP, if you have PPE of 1.5, or let's say you have an asset of 1.5, and now your asset has declined, that means that you will most likely have sold an asset. And since you've sold the asset, by the time you sell an asset, right, you receive money. So that means there's an inflow of cash. And reverse is the case for liability. So generally, since your current asset is more than your current liability, it means that there's more asset that you have than your liability. And by the time you start, looking at the changes in working capital, this will most likely be negative. So the way to think about it is that you look at the previous year, because this total operating capital is the excess of asset over liability. So when we are looking at the changes, we look at previous year minus current year. If we're looking at liability, we look at current year minus previous year. But because this is positive, right, this is showing that we have more asset than liability. That means that, we're going to look at previous year and current year just to show you how the working capital is increasing. This one may not make sense to you. When we get to like changes working cash flow, you understand what we're talking about. And this is just a sanity check to be sure that what we have here is the same thing what we have in cash flow. Right now, it won't be the same thing because we've not modeled out our cash flow. Is there any question? Or because right now, since we are done with the working capital schedule, I can start linking it to the right places. Do you have any question? Or should we take a break?
If you have any questions, please drop it in the chat box, or you can also raise your hand to talk.
And can we take a break? Or
if you want to go on a break, because I'm thinking it's already 6. If we go on the break now,
people won't come back.
Most likely.
Oh, okay. I'm trying to rush this as much as I can, but essentially just want me to just do it without talking. Okay.
No, you have to speak. But okay, before you start, this is already 6:19 p.m. Can we get to a hard stop by 6:47 p.m. so that it doesn't become too long?
Okay, 7 p.m. means that I would do less talking. So let's try.
Yeah, then maybe we will try to schedule another class if this session is not sufficient.
Okay. Okay, we'll see. So now, since the schedule is done, I'll come to it's going to affect a number of things, right? So let's start linking. First of all, let's link our current assets and current liability to our balance sheets. I go to my balance sheet. I will link, right? Equals to schedule. Here I pick. Again, I make it in red. I just need to do the first year and I would drag. So I will try not to like do one by one. Equals inventory. I pick it from the source, which is 325. This is it. Prepared expenses, schedule. Pick the right figure. Then, right. Other current assets, even though it's zero, we are still picking it anyway. That's the right thing to do. And because we are going to be linking current working capital also like to cash flow, anything we are doing, always pick from the source. So because we've linked it here, don't then start picking from balance sheet and all of that. So that's just something to quickly see. I can do this already. Current liability, let's do the same thing. Accounts payable equals, we've done that. Accounts payable, I pick it, right? Let me just make this red. Accrued salary, pick it from the right. Okay. So I'm going to leave short-term debt for now because we've not, let me just fix. So other current liability also equals schedule, other current liability. Okay. So, okay. And so I noticed something here because when you're looking at the model, so you don't start asking questions, this should be in black. So now we are kind of like done with the working capital part of the balance sheet. So let me see if I can just touch on this test schedule. I want to be, that'll be the last thing we'll do. So let me leave it. So let's go to cash flow and let's start linking. Okay. So in cash flow, we go to we already have our net income. So basically we're trying to adjust, make some adjustments, right? Do the right adjustments. And if we have the right figure coming from our income statement and balance sheets, then cash flow should be fine. So, okay, before we start every other thing, the changes in working capital, right? So now, the changes in working capital, accounts receivable, because we've linked balance sheet already from our schedule. Some people will want to start picking it from balance sheet, but I think you should still keep working with this with the actual source. So changes in your account receivable is going to be equal. I come to my schedule, right? So account receivable. Now, the thing is account receivable, I remember I told you that an increase in asset means that an outflow of cash, right? And for it, the way you know it, the way that would reflect is that previous year minus my current year. So if the current year has increased, that way it will show a negative, right? To show that there's an outflow of cash, right? So I'll keep this as, let me just, because I'm going to be linking. Let me put it there. To be honest, you don't need to put red. Black is just enough. Like most of it is just blue and black. But for you, so that when you're looking at the module, you're like, okay, this one is coming from somewhere, definitely. It makes more sense. So changes in inventory, I go back to my schedule. So assets, because it is asset, I'm going to say previous minus current, right? My changes in prepaid expenses, I come to my schedule. Prepaid expenses, where is it? 129, that's previous minus current. Okay. Changes in other current assets, schedule previous minus current. Okay. Now, liability is going to be different. So you're going to now pick current minus previous, right? So current minus previous if it's showing positive, it means that there's an inflow, okay, of cash that you're using. In the meantime, changes in accrued salary, current minus previous, okay. Other current liability schedule, current minus previous, okay. Then I'm just going to, when I sum it up, it shows me the changes. So here, if I just to test, these are called sanity check. So just for you to be sure that, because we've done the first year, so it's showing that it's true. But we've not done the other year, that's why it's still showing false. Right now let's drag this. So what we are doing is we are doing the model bit by bit. Sanity check shows that this is interesting. 275.5. This must be estimating error. Let's leave it in the meantime. So let's do our net income, right? So net income statements. I come here, I pick the right number from my net income. Again, this is all. Depreciation, we already calculated it from our schedule. So we also bring depreciation from the schedule, right? 2023, in red. Okay. Amortization, this is, we didn't model this out, so 0, because again, that's not been, there's nothing there anyway. So we don't have any deferred income tax, right? And because cash flow is showing you, like, it's showing you movement of cash. This is going to be 0. So I'm going to keep it as 0. It's going to be coming from here. Let me just, we don't have any deferred. Deferred tax is something that as a result of the temporary differences. When you read about it, probably you would to make more sense. So here I'm going to, because it's coming from another sheet. So right, okay. So so now the total cash. Now by the time we add all of we sum all the first part up with the changes in working capital, it gives you the sum of cash that is using from the operating activity. Okay. So capex, we already have our capex figure. Okay, we've done that initially. We already have an assumption, so we bring it out. Again, it's coming from that source. So I'm going to okay. Then proceed. We didn't sell any assets, so equal to 0. We didn't acquire any business, so in fact all of this is 0, right? Okay. So I would sum it up. Okay, so this is just to show you again. Sorry, capex. When you have capex, right, it's supposed to be negative because it is an outflow. You're purchasing assets, so this has to be negative, right? So it's just, I'm rushing now. I'm going to leave this two for now because this is the thing we're going to do last. The debt part, right? So we didn't have any proceed from no issuance, nothing, no repurchases. We did pay dividend, right, in our income statement, so it has to be negative here because there's an outflow of cash. So here, this we didn't have any minority interest getting any money, nothing like all that. So this is the only thing. Whatever you're seeing here, the only is dividend. So okay, so that's like all linked up now. Okay. Now, total change in cash and cash equivalent. Now we've done our operating activity. We are done with our investment activity. We are done with our financing activity. Of course, we have not factored in our the repayment, that which is the last thing we'll do. So we'll add all the total. of each of the category, the section of the cash flow. So by the time you add it together, you have this. So now we are going to come back to debt before drawdown. So let me just, so basically what we are trying to look at for debt before drawdown is that once we look at how much cash flow do we have if we don't factor in anything like loan, anything like loan issuance or loan repayments. So this will make more sense when we are building our debt schedule. But right now, we are picking all the sum of operating activity, investing activity, and financing activity, except for short-term borrowing, like the debt aspect. So that's like, right now, it's going to be the same thing with our changes in working capital. It's going to be the same thing right now. So so up until now, do you have any question? Like, because we'll go back to we'll go from our cash flow now, we'll go back to our balance sheet and we'll do what we can do in the balance sheet before we now go to the final part, which is the debt part. So if there's no question right now, we are done with our cash flow technically, apart from this. Again, remember, we are not done with our income statements. And what is affected, what is not done right now is the interest expenses and interest income, which is going to be coming from, or which is as a result of the debt here. So debt here is what the debt, short-term borrowing and long-term borrowing is what is causing the interest expenses, and our cash balance is going to be what's going to affect our interest income. So that's why you can see that part in the income statement is not done. That part in the cash flow is not done. So balance sheet, let's do that thing. Okay, right now, of course, we can't do cash off now too, because that's the last thing we'll do. PPE. So to calculate our PPE, so like we said, that PPE is affected by a lot of things, right? So this is the opening balance, right? And remember that we have a capex, right, somewhere. So we purchase a new asset in our cash flow. So I'm going to come back to say, normally I should have done the proper PPE schedule. I could have done the breakdown, just bring it to total. But since I didn't do that, so I'm just going to like do it manually. So I'm going to say PPE, or the old PPE, right? If I buy a new asset, because I'm saying minus because this minus will cancel this minus, right? So minus my minus is going to be plus. If I say equal to right now, it's going to increase by that amount. But again, remember we still have our depreciation, right? So opening balance of PP, add capex and deduct our what? Deduct our depreciation. So depreciation, of course, in your cash flow, we already have depreciation here. So, and that gives you that gives you PPE balance. Goodwill, usually arise when we have bought by any company, so we don't have anything like that. Pension assets, we didn't model pension assets. So since we didn't model it, that means that we are not, no activity happened as like this year. So that means that it doesn't change to zero because this is balance sheet. So that means that the balance as of last year remains the same. The same thing applies to our long-term asset. We didn't model this out, so it's going to be the same. So now you sum that up and you get your value. So that way I can easily do this right now. Okay, this one also I can still sum it up, even though I don't have my cash balance yet. It doesn't change anything. So I can sum all this up too. It doesn't change anything right now. My long-term debt, right? So this is going to be coming from my debt schedule. Deferred tax liability, we didn't model deferred tax, so it's going to be the same. Same as this pension, we didn't model it out. We didn't model this out too. So the balance from last year is going to be the same since nothing has changed. So I'm going to keep it like this. I'm going to sum it up for now. Okay. Okay, so now preferred stock, like we didn't issue stock, there was nothing that happened like from last year. So I keep it constant. Same as the common stock, nothing changed. No additional repurchases. Of course, nothing about this. The only thing that will change here is the return earning, and of course, for you to do a return earning is like going to be what your return earning from last year. It tends to increase by your what? It tends to increase by net income balance, right? So let's pick it from cash flow because cash flow should be driving it. So net income, which is this, then we deduct what? We deduct. So because we deduct our dividend, but because this dividend is already negative, I'm going to say plus this. And you have 13, have I picked out the right thing though? So let's sum this up. Okay. Okay. So here also, I'm going to, this is just like to calculate my liability and my equity. So right now, of course, your balance sheet is not going to balance because we have not captured everything. So now, I think up until this point, like I know I'm rushing, but I don't think I should be rushing so much in a way where we're not getting anything. So like, do we have any question? Do you have any question? Can anyone hear me?
There are no questions.
There are no question, right? Okay, that's fine. Okay, so if there are no question, then let's go back to building our debt schedule, which is like, the last thing we would do for today, then kind of like that sums everything. Now, so for your debt schedule, right? There are different ways to build it. This is a little bit, I think, thinking about it now, I think it's a little bit complicated. So I've broken it down into the cash, cash balance, the short-term debts, the long-term debts, right? So the cash balance is what we're going to use in driving our net income, our interest income, and the debt is what we're going to use in driving our interest expenses. So now, at the beginning of the period, right, we have a cash balance sitting in our balance sheet, 7,311.8, and that is what you can see here in the schedule, 7,311.8. So sometimes some company will tell you that to accommodate liquidity or to be safe and all of that, they tend to give a particular amount of money that we won't go below this cash. So for this company is saying like, in the worst case scenario, we won't go below 10. Like we will always have like a minimum of 10 in our books. So what that means is that if the cash at the beginning of 2022, which is like 2023, is 7,311, the cash flow before debt drawdown, that is, you've not paid any debt. How much cash do you have as a start? Like, let's say before you pay any cash, and that is why we did this cash flow before drawdown of 3,000. Where is it now? 564, right? This is the amount of cash we have before we pay any debt. And we are saying that minimum, we must always have at least 10 in our books. So by the time you add your cash at the beginning of the year, before the cash you had before, and the new cash you now have right now, and you deduct the cushion that you must have in your books, it shows you the total available cash that's available, the total cash that you have that you can use in paying out any debt, right? So when I sum this up, it gives me 10,866. Okay. So now we have short-term debt. We also have long-term debt. All of this is coming from your balance sheet. So your short-term debt here now, where is it? Where is my current liability? So my current liability, as you can see, so I have a 700 that I'm owing, short-term debt. Long-term, I have about 1,000 that I'm owing. So this is the this is the closing, this is the balance as at 2022. So I bring this balance as an opening for 2023, right? So that is why you can see it here, 700. So there's some debt that based on the term of the debts, you have to pay a certain amount of money at some point in time. Here, I'm just going to keep it as 0. So let me just turn it to blue. I'm going to keep it as 0. And I'm going to assume that we are actually making our repayment. If you remember the repayment thing that we did the other time, right? The repayment structure that I showed you during the scenario analysis, I might do that for this repayment structure and all of that, but for this one, if I have 10,866.5 in cash and I'm owing 700, at least I can just easily pay all of these amounts anyway, just now. So what I'm going to do is I'm going to say that minimum, I'm going to use the minimum now, and it's going to make more sense for you. So minimum of, sorry. Okay. I'm going to say that equals to, right? Minimum of this, how much am I owing? I'm owing 700, right? And I have this amount of money. So if I have this amount of money, that means that I can easily pay off everything. So if, let's say, for example, this one was 0, I don't have cash. So that means that even if I want to pay, there's nothing to pay. And that is why I'm saying that just give me the minimum between the total cash available, the cash that I have, and the cash and the debt that I owe. By the time you look at the minimum of both, the difference, or whichever is like is lower, then will reflect. So since this debt is 700 and I have 10,866, then that means I can easily pay it off. And of course, the ending balance now is, let me just sum this up. Since I have 0 now, that means the opening balance here is going to be 0. That means, and again, this is let me just keep this at 0. If you do the minimum of this and your opening balance, let me equals to, okay. I'm going to put this cash flow 2024. Okay. Okay. So, since I already paid this 700 in full, and I don't have any debt at the beginning, then of course this minimum is going to be 0. Like every now and then, I don't have any balance to pay up anymore. You can study this like at your own convenience, I guess. So let me just copy and paste all this. Need to paste all this. Okay. So now, thing is, if interest rate, like, this one is an assumption. I'm assuming that interest rate is going to be like, 3% of like my debt every now and then. So, and I'm assuming that there are different ways to look at this, and this is where circular referencing will come in, right? If you have 3% interest expenses, 3% interest rates on every short-term debt that you have, I can say that if I want to calculate my interest expenses, it will be 3% of what I'm owing. If I do 3% of like the beginning balance, which is 3% of 700, it should give me a value, right? That amount that it gives me, right? That amount that it gives me is the actual interest I'm going to pay on that debt for that particular period. But some people will argue that why should you use interest at the beginning of the period? Like even if you are making the payment, are you actually making that interest payment at the beginning of the period? So most of the time, people tend to use average. And by the time you start using average of interest expenses, you start having circular referencing, right? And that is where I think I would allow you to go and study circular referencing on your own, like rather than me trying to do circular referencing for this particular. I won't create a circular referencing for this particular Excel, right? So I won't create it. So what I would do is I'm going to pick the interest expenses and I'm going to apply it on opening balance. Okay, I'm going to apply it on opening balance and I'm going to just keep it at that. If I use average, if I had done, let's say, 3% of which most people will do. Sorry. Average of these two periods, because you expect that's where you have expected to pay the money and it will give you a different figure. So, but I'll keep it at opening balance. If you do that, and by the time we start linking it up to the income statement, it will create a circular referencing. Or if you pick the ending value, it will create a circular referencing most likely. But I'll let you go and study circular referencing and how to prevent it. What you can do, I'll allow you to do that at your own convenience. So let's leave it at that. So here I'm going to pick, instead of picking the average, I'm going to pick the opening balance of my debt. Okay. So now we are done with the short-term interest rate, right? So let's do the same thing for long-term interest rate. So I'm going to keep this one at 0. I don't want to retire this. Let's keep it at 0. So when you're studying, you see like the different options that you can have. So I'm going to sum this up because I want to have an interest. I want to have an interest expenses like year on year. That's why I'm doing this. So let me just keep this here. Okay. So I'm not going to do average to avoid circular referencing. So I'm going to do, sorry, opening balance. Okay. So now I have an interest expenses for short-term debts. I have an interest expenses for long-term debts, which in Giant's case, in the other time when he was asking if you have different debts. So the interest expenses that will go into your income statement is going to be the addition of all of the interest rates of the different kind of debts that you have in your book, right? So let me see. Now, for cash flow purposes, right? You want to know how much of debt did you acquire additional debts? Did you retire additional debt? If you acquire another debt in your cash flow in financing activity, if you acquire another debt, that's an inflow, right? Because you receive money. If you retire debts, that means that you've paid back, you've made a repayment. So that's a cash outflow. Sorry, excuse me. And for you to, in this case now, we want to know, how much did we issue any debt? Did we retire? So now, I think for short-term debts short-term debt, you can see that we made a repayment, right? So we had a repayment here. So I'm going to say this plus this, plus this plus this, right? So this is the total amount. So, and this is an outflow because we made a repayment, and that's why it's showing negative, right? Your total expenses, your total interest expenses is going to be what? It's going to be the interest expenses you are paying for short-term debts plus the interest expenses you are paying for long-term debts, okay? That's going to be this. So let me just look it up quickly. So cash at the end of the period now, right? You are going to say, remember that equals, what's the cash? Sorry, this, right? Plus this is the opening balance is 7,311. The cash flow before debt drawdown is the one that we were bringing from our cash flow statement, right? So, and you add it to like short-term drawdown, okay? Then drag it, okay? So I think that kind of like captures everything that we're supposed to do as far as the debt schedule is concerned, and we can easily link up now. So remember again, we would have had a circular referencing if when we're calculating this debt, we had done the average of the loan in calculating our interest expenses. But since we didn't do that, we will most likely not have a circular referencing, okay? So equals to interest expenses schedule. Where is it now? Interest expenses. This is it, right? And interest income. Oh, we've not calculated interest income. So for interest income, we already said interest income is going to be 1% of 1% of whatever cash that we have at the end of the year. So since we already have, like, again, I'm going to avoid any circular referencing. So I'm not going to use average. I'm going to use the, like, just give me the interest expenses on my opening balance, okay? So, right, I'm going to come to my income statement equals to schedule. I'm going to bring my interest income, okay? So now we have something. Let me remove this color. No fill. Sorry, I think I use this. Okay, because again, this is coming from an external link. Let me put it in red. Okay. Control R. And now technically we are done with our income statement because we have captured everything we should capture. And balance sheet, we have our short-term debt right now. So we've calculated short-term debt. So if you, just a minute, sorry. Let's go to, oh, okay. So in our cash flow statement, right, short-term borrowing equals to, let's go back to our schedule. In our short-term debts, remember that in our short-term debts, we didn't have an insurance. What we have is a retirement, right? So you pick this to show, and of course, it is an outflow. So long-term debt, we come here. Long-term debt, we didn't have any insurance or retirement. Normally, I should be picking the mandatory and the non-mandatory one. So let me come in from here. Control R. Okay, so technically we are done with our income statement and our cash flow. So we can easily like finalize this. So equals to cash flow sorry, no, that's a wrong thing to do. No, actually, that's correct. So click on this. Let me remove this. I know this is a recorded session, so you can easily just go back to it. To be honest, long-term debt equals to there was no borrowing. Oh, sorry. So now, thing is, think there's an error somewhere. Okay, another error. So sorry for your balance sheet, right? Remember, there's a balance here before, right? You don't just pick. What I just did is I just linked the cash flow. So I'm supposed to have done like when we're dealing with like liability. So this is the previous year balance, right? So plus I'm supposed to come to cash flow and pick this. Since initially I had 700 and now I'm making payment of 700. So how much will I have right now? It is going to be 0. So, and my long-term liability, initially I had 1,000 plus any insurance, any retirement will affect it. But in this case, I didn't have any insurance and retirement, so the balance is going to remain the same. Okay. And I think technically that should capture it. Except if I had an oversight on something. So I think, oh, okay, cash balance. So for our cash balance, remove this. So for cash balance, we have this right initially, and what was the cash that we had at the end of the period? So we had that to it, and should and that is pretty much it. Except let's just double check whether we have the right. Let me see. No, sorry. Balance sheet here. Okay. Okay, so we don't have the actual balance. Trying to like understand what's the issue here. Okay. I think we've not captured. We didn't total this correctly. Okay. And yeah, there you have it. So we've totaled everything that needs to be totaled, right? The current assets, I think what the error here was that we didn't add the current asset to the long-term assets, right? And that was why we're having like, it was only capturing the long-term assets balance. So by the time you add the total current asset and the current asset and current liability, you have your total asset, and current liability, long-term liability, and your equities. You have your total liability and stock and equity. So by the time you add that together, of course that should balance. So I think we are done with our income statement. So now for the scenario analysis thing, just to like see whether our balance sheet is or our financial model is dynamic or not, I can easily come here and look at the best case scenario. Like from here, we have about 8,817 in the final forecast here. If I change it to my best case scenario, it has moved from 14,639. If you go to balance sheet, it should drive normally because the balance sheet would also have like adjusted. The cash flow would have adjusted. The schedule, whatever it is that we have linked to the revenue, cost of sales and SG&A would have been affected, and that should keep driving the model. So that way you can see best case, worst case scenario for each of the line item, and nothing should be changing. Everything should drive into one another. So I think I've managed to. I have just 1 minute left to the time that I was given, so I think I was able to manage to squeeze in. I know it was very rushed. I'm sorry if, probably there is anyone on the call that doesn't understand, but you can easily go back to the recording session. And I'm also going to share the completed module, and you can easily just walk through it, go through it, look at the videos, and do some comparison. Hopefully that would be helpful. So if you have any question, I think we can have it now.
Thank you so much, Damilola. Thank you. I learned a lot. I don't know about other people, but me, I learned a lot of things, especially with the use of your scenario case, use of scenario that you taught in Excel. That was very, very insightful. Thank you once again. I don't have any questions here from the members, from the participants. I have no questions here.
Okay.
But just to encourage everybody, I know that it might look like a lot, especially if you don't have any para Excel knowledge, or especially Excel knowledge. A lot of this is, the use of Excel. We shared the materials previously last week on the use of Excel. So you can always go back to that. You can always get in touch if you're still unclear on how to use Excel. That way it will help you put a lot of what is being taught into perspective. So thank you once again to everybody. Thank you, Damilola. Tomorrow we have another session. I think the first session is to start at 2 p.m. So we look forward to seeing everybody there. Thank you. Thank you.
And I think just a quick one. I'm going to share I'm going to share two models with Samson. So one is that's the one we did now, which does not have circular referencing and all of that. So I will send that, and I also send the completed version of that, the one that has the financial circular referencing. So that way they can look at, what they could do to manipulate if they have circular referencing in their module.
All right. Thank you very much for that. We'll look forward to receive. As soon as we receive it, we'll share with everybody. Thank you, everybody, and have a good evening. Bye.
Cheers. Bye.